Okay, we left off on this buying climax. And I had a gentleman come up during the break and say, on camera, could you really talk about what is an up bar and what's a down bar? And it's a good question, because I assume everybody knows, but as we're here filming this, to make sure that you're going to come back and study it, an up bar is simply this. It's not like e-signal does it. I'll put it that way first. E-signal says an up bar is a close that's higher than its open. If you look on e-signal bars, you'll have a green bar if the close is above the open. What I mean, from a Wyckoff volume standpoint, an up bar is a close higher than the previous bar's close. All right, and I'll say it one more time. And let me do this. We'll put it right on here. I'll start using my tools. Okay, that's the previous bar. That's an up bar. This close is higher than that close. If you did something like this, that's not an up bar. That's a down bar. Even if it was like this, even if its open was here. See, E-signal would call that an up bar. Wyckoff would call that a down bar. That is a down bar, just to be redundant, because this close is lower than that close.
The high could be higher.
Oh yeah, you could do this. You could be way, that would be an up thrust. We're going to talk about those in a couple seconds. That's a bad bar. I love up thrust for shorts. But before we get to up thrust, we've got to finish buying climaxes. So again, we left off saying that this generally is going to occur on very good news, and it's being reported everywhere. You're going to read this in the newspaper. You're going to pick up the USA Today, the Investors Business Daily, Wall Street Journal, your hometown paper, and they're all going to be talking about how great things are. I don't know if it was Denver last year or not. I'm thinking that I gave a presentation here right when the Dow hit 13,000 for the first time. I said, be careful. I don't know if that was here, if that was at another seminar I did, but just as we would expect, the Dow hit that big number, and from that big number, it fell. It fell hard. Every time we hit new highs and a lot of stuff, you're usually going to look for an automatic reaction down. It's just the way things work, because the public's going in and buying, because it's a new high, and I got everything's good. And it's just an opportunity for professionals. But this bullish looking activity is hard for the retail trader because it looks so good, it feels so good, and it's hard to say, well, that's got to be weakness. But 9 times out of 10, it is weakness. I'll get to you in a second. The bullish looking activity is followed by a market decline. This is what proves that the largest were selling in the up move. Remember, they have to sell in an up move. They have to create an up move to sell into, or an up move has to be created to sell into, because it's not always going to be them, right? We might just get a good news release. Maybe we get that hocus pocus that happened Thursday and Friday. For any of you guys that trade indexes, hey, Thursday employment looked great. Friday, oh my God, what happened? One day later, government reports. Thursday it's good. Well, Friday is not good. And these are really things that show us that it's not a level playing field. You can't take anything you hear at face value. It's not for your benefit. It's not for your interests. The herd is being driven, and the news and the reports are one of those ways. And those reports, I know I said this last year, but you need to hear it. Those reports, the results of those reports are known before they're released to the public. And because of that, the smart money knows how the public is going to react to the news. It's that simple, and they take advantage of it. You had a question, sir?
Yeah, wouldn't a good recent example be the...
Can I stop you for 1 second? What I want to do is start passing this mic around. Thank you, Mike. This way we can record it and everybody can hear it.
Okay. Todd, question for you. Wouldn't a recent example be the campaign that occurred in gold? And you saw these TV commercials, buy gold, buy gold, buy gold, buy. It was on the TV, radio, talk radio, everything. And then it hits, roughly 1,500, and bam, you have up thrust on daily bar, and it slams down $100 an ounce.
Yep. And I've got a good story about that. I mean, I was around in 1980, 79, right, in that time. And it's funny. I mean, you want to talk about the herd. I'm going to tell you about my dad. My dad, in 1979, 1980 time period, when it was on the TV, we buy gold, we buy silver. He's out selling his gold and silver. I got old jewelry I don't need. I'll let them melt it down. I got my old silver coins. He saved some silver coins. And what did my dad do? Like, it was probably 4 weeks ago. He went and sold his silver coins. I mean, this is the herd mentality. This is exactly what happens. And when you start doing that, you know you're getting close. You know you're getting close to a top, because it's panic kind of, and that's not a panic in a bad way. That's panic in a good way. People say, my God, I can make money now. Look at this. What I thought was worth nothing. And I know I've got a friend, his dad bought silver bars. I mean, he's got a lot of silver bars, and he's still holding on to them. He bought them in 1975. He's an old guy, but he's still got them. He thinks silver's going to the moon. But, when this stuff, every day out in my local paper, and for some reason on the sports page, we buy gold. Right there, clear as bell, front page, we buy gold. Yeah, when you start seeing that, you know you're pretty close. Okay, so this is going to prove, this bullish looking activity followed by market decline proves that large interests were selling into the up move. That's what it looks like. To go back to the gentleman's question over here, said, can we measure that? Hey, maybe you can, right? But I can see it. I just see it. It's there. There's no mistaking. This I look at first, and look at the way the velocity of that bar increased. It's just, there's no other way to describe how that could happen. And the last telltale sign of it is we're closing off the highs, right? The supply's up there, it's starting to drop down, it's starting to get hit, and it drives it down to close off the highs. So we know there has to be some selling going on there. It's just logical deduction. When we know how to look at it from what they're doing, what Wyckoff told us, understand how they have to play the game. They have to sell into this up move. You can actually see, if you go back and look at this chart, isn't this a little microcosm of that bigger event later? The velocity of both of those increased there. The velocity of that bar, the price bar, the velocity of that volume. But that's not really as evident. It doesn't stick out like a sore thumb. But that's where that started to happen. This happens to be General Motors on a daily chart, right? And this is recent. This is April 30th, 2008. General Motors up around 24 bucks, and it went down to about $16.50 before May was over with. So you're holding General Motors at 24, it goes down to 16, and what we really haven't seen is a tremendous amount of like a selling climax. We really haven't seen that yet. So, this thing's still going to churn around. It doesn't look like this is the bottom. We haven't got rid of the people that bought it up here. Those people that the transfer of ownership happened up there, they still have it. They're not out yet. You could say you got a high volume test down here. That's a high volume test. That denotes that we probably have more testing to take place. Then we start to move down. They mark the price down. Let me find my arrow here. I'll just point with my hand. Start to mark the price down here, and what's happening? We got sellers, right? We've still got interested sellers as this price is marked down. There's sellers there. So that's something to be aware of. Got to be careful of that. Yeah?
That bar went to the higher high than the previous.
Can we get the microphone to Mary? Just pass the mic up. Thank you.
We went to a higher high on the last bar, and we went to a lower low. But we closed near the low of the bar.
This bar.
No, the last bar.
This bar.
We went to a higher high
Yes.
than the previous bar.
Uh-huh.
And we went to a lower low than that previous bar on higher volume.
Right.
So that's your expansion on price on volume.
Well, the way I don't know exactly what you're asking, so the way I would say this again in a different way is we tried to push price up, right? Price was pushed up, and as we hit that price up there, this is again when you want to go down on a lower time frame. So the market profile woman back here, she's going to go to her market profile chart and say, did I hit volume up here and it sold it down there, or did I hit volume down here and push it back up here? That's really going to be the telltale sign. With one time frame, I can't tell you that. With just this general chart, though, we hit higher highs than we have in the past few days, actually past 5 days. But once we did that, it got pushed back down. With just this chart alone, I would say that's supply, without knowing more. If you tore this apart, and we start going to 15-minute charts, 30-minute charts, market profile charts, we can see if the volume came in here to push it down, or if the volume came in down here to push it back up. That's going to be important to know. You're going to want to know which one that was. Okay, and we've got a question back here. Can we?
Is it on? Question about the way your charts are constructed. There seems to be a conflict between Wyckoff and bar charts. On most charts that we see on this end, a price that's higher than the previous bar would be colored green. If you look about 10 bars over from the far right, you see two fairly small red bars.
Yeah,
They look like they're coated like a candlestick would be coated.
right here you're talking.
Yes.
Yeah, the question, and in case everybody didn't hear it, is, yeah, this kind of looks different than what we would look at like a Wyckoff chart. And this, I tried to explain it up front with the E signal. E signal says this is a down bar, not based on the close being higher than that, but based on the close in relation to the open.
So that's the way a candlestick would be coated, but not the way Wyckoff. And so we need to sort of mentally think.
Well, I'm
through-
going to show you how we can apply it to candles in my next presentation, though.
Okay, great.
Yeah. Okay. You can see it. I mean, it's just there, like a sore thumb. You can't miss it. The telltale signs, the velocity of price and volume, right? We especially would like to see a couple things when we really look at this rationally. We would like to see it close off the high of the bar, denoting there was some selling going on. We would also like to see in the following few bars, that the market's reacting to what we believe is selling. If the market just keeps going up, here's what you got to be careful of. Wyckoff would tell you that we also have to be careful of old ranges to the left. Here's an old top to the left. And in this case, it really wouldn't be ideal, but we're pushing through that, but we pushed through it on this bar. And when we pushed through it on this bar, we did get an increase in volume, and we would call that absorption volume. The supply is being absorbed, because anytime you get in a range type situation, and you're gonna trade sideways for a little while, and in that sideways, you're gonna go down and you're gonna come up, and there was a point of pain here. So these people that had long positions here, market fell against them, they had to hold on with pain. Remember, retail traders hold their losses too long, and so do mutual funds, and Warren Buffett does too. And but he can afford to. So it comes down, it comes back up. Whenever we get to this area again, we're going to expect to have supply hitting from the people that owned it here, right? These people want out now. Now their prayers were answered. I got back to break even. Thank God, I'm out. So we're going to have supply hit us on those times. So that's what you got to be careful of when you see this. This is another thing to look at. You say, where's my old ranges to the left? Am I taking out an old high that was sitting back there? Now what you wouldn't do is take it to the ridiculous and say right here that that's an old high to the left that I took out. That's too soon, right? There's no pain there either. The market went sideways, then it went back up. So you're not taking out an old high where there's pain involved with people that bought it and had to hold on to a losing position for a while. Totally different. You got to understand the psychology of how the professionals think and how we all think as retail traders. You know, you have the same feelings that John and Jane Q. Public have when you're holding on to a losing trade. Trust me, everybody feels like that. You're not on an island. And if you can parlay that thought into how the mass feels now, right? Now the mass feels this way. How is a professional working with that thought process? Because they are. That's how the professional looks. They prey on us. That's what they do. And you would do the same thing if you were them. So you can't hold it against them. And in reality, all winning traders do it against the losing traders. I mean, I love losing traders. I like to teach people how to be better traders, though, because we can have a lot more successful traders and not impact anybody as far as, well, if everybody knows how to do this, then it won't work anymore. That's baloney, because the professionals have to, unless they can find a new way to get out of the long positions without getting the herd to buy, it's going to work like this forever. And unless they can find a new way to buy something they want by getting the herd to sell, it's going to work like this forever. So I'm not teaching you something that's not going to work anymore, right? This is universal. Buying climax. Here's the super charts again. And this is a Japanese yen futures contract on a weekly contract. It sticks out like a sore thumb, right? And you can look and you can say the velocity of that price increased. It doesn't look as dramatic as the other things, but I can tell you that scaling has an issue with this too. So you got to watch how you scale your charts, because sometimes when you squat them all together, the price range is going to look smaller than it might be if you expand it out. You got to kind of look at that and play with that. That's one of the little tricks of charts. You got to be careful with that, but you cannot make any other choice here than to say there was professional selling going on. And there's going to be another telltale sign that came after that we're going to talk about in a couple seconds or a couple minutes, and that's a no demand bar. Right? And I'll talk about that when we get there. But right after this buying climax, we had a no demand bar come in here to prove that there's no more buyers up there. They got rid of all the buyers. You can see what happened to the price. It might not look that dramatic to you if you don't trade currencies, but this thing went from a high of about $1.04 down to about 95 cents. That's 900 pips. That's a lot of money. That's a lot of money. Okay, no demand. No demand bar has to appear on an up bar. I'm glad Mike asked the question earlier, what is an up bar? The close of this bar has to be higher than the close of the previous bar. That's an up bar. A no demand bar appears on an up bar closing above the previous bar's close, right? Up bar, preferably with a loss of velocity in the price bar. So now all of a sudden we don't have this big wide bar. Now we've got these littler bars. We want to see greatly reduced volume. What this tells us when we see that, it's not just like a magic code, right? You got to understand the psychology behind it. That when you see the lack of volume, the reduced volume, you know there's a lack of buying at that price level. There aren't many interested buyers. Certainly no professional is sitting there buying that, because professionals are the vast majority of the volume on each and every volume histogram bar. If they're not involved in that thing going up, why do you want to be? And this is especially right after we've seen the buying climax. Now we're starting the distribution process. That starts distribution. You want to see no demand. That's what you want to see. That's going to prove to you that the professionals no longer want the long side. Doesn't mean we're going to go right down, because they still could own more of what they're trying to sell, and they're trying to get rid of it. So they're going to keep trying to push prices up, get you involved. Market might just start falling because there's no buyers. They're going to put the hypodermic in there again and get the public involved again and get rid of every last inventory they have out of their hands, create their new inventory, which is short, and then they're going to allow the price to fall. But only after they've got rid of their inventory and established a new inventory can they do that profitably. Here's what it looks like. Now let's go, you see right here the vertical cursor. What does this look like? It's a buying climax, right? It's not as dramatic. What you see over here, right here, and I'll come and point to it too, what you see here is kind of a fractal of that, if you will. It happened down here, that starts it, and then that is the hypodermic. That gets it, and now they're done. And how do we know they're done? I mean, it's easy to see. There's no guesswork here. This thing went from $53 down to $44 now, right? So as you're learning this, you're not going to be real confident saying, oh yeah, hell, I'm going to short right there. I'm a genius. You're going to have to look at charts and say, well, that's what this chart did. This is what I recognize. Hey, can I see the buying climax? Do I see it? If you don't see it, it's probably not the end of the up move, right? Very few big moves end on no buying climax. You might just have a retracement down, and then you're going to start back up again. But when we have these buying climaxes, then these no demand bars are just confirmation there's no interest in higher prices from professionals. It doesn't mean that they're out of all their positions yet. So you still could have a little sideways action, and you could have the next thing we're going to talk about happen, which I'll get to in a second. But here's the no demand bar. This is really interesting. This is my super charts again. This is cotton. Does anybody trade cotton? I don't trade it, but it's an interesting chart. We've got this little no demand bar here. What we don't really have is a buying climax at this point. So we've got a no demand bar preceding, so we've got weakness preceding this really big weak bar that comes up next. We call this an upthrust, but in this upthrust, we've got all this volume coming in too. So what happened here, you'd want to go down on a lower time frame chart and confirm all this. If you traded cotton, you'd want to make sure that the volume came in on there, up on top, not on the bottom to support that price. Right? That's a little intricacy. Can we get the mic to Mary? Where's the microphone at? Previous chart. Wait for the mic.
Okay, on May 5, the third bar, or the second bar after the high volume bar.
Am I close?
Okay, yes,
Right
now,
here?
no, the next, in the middle, one to the left.
Right here.
Yes.
Okay.
That bar said there was no volume pushing it up, and that was an important bar as well.
Very good. That's a no demand. See, that close is higher than the previous bar. And look,
Right,
there's no interest.
right.
Yeah, there's no interest.
Okay.
That's a no demand bar, picked up on. Now that's what makes me feel good, because people are seeing it now, and I'm not bringing it up. You guys are seeing it, and this is where you need to be when you get home. So you got to watch the tape over again, probably understand exactly what I'm saying. It's, for those that are hearing it the first time, this is a monster to put your arms around, right? But the logic is clear. There's nothing about the logic that doesn't make any sense. It's just that it's different than what you've heard before. So we'll go to the upthrust, and I'll go back to that chart in a second. Upthrust occurs when a price bar exceeds the high of the previous bar and then closes in the lower portion of the bar. Right? That's when an upthrust is going to occur. So we're going to take out the previous high. And it doesn't have to be a close above the previous high. We just have to have the price action go above the previous bar's price action high. And then, once we have that, we want the close of that bar to come down. If you want to put it into more mechanical terms, maybe the lower third, right? Lower third of the bar. You definitely don't want it really in the middle of the bar or higher, because then that's not an upthrust. But if you have it in the lower third, what you really like is even below that. And we can see here is a perfect upthrust. Forget that arrow right here. That is a perfect upthrust. And that's significant as far as weakness, and it's confirming the no demand weakness that was just before it. So sometimes, you know, the Wyckoff stuff, you're going to say, well, if you hear me saying this stuff, it has to follow this, follows that, that follows that. No, you got to give it some freedom, right? You got to say, well, if I see no demand, can I see any other signs of weakness in the background? Is there anything behind me other than that no demand? And I'm going to show you a trade example today. We'll show you that. I'm going to not exactly that scenario, but about how you have to use your brain to figure this stuff out. And the great thing about this is you're doing something when you do this that nobody else is doing in the mass public. Professional traders do this. They know how to read charts. But, you know, retail traders aren't out there saying, well, you know, that's no demand and that's an upthrust. And, you know, they're talking about stochastic crossovers and moving averages and MACD divergences. And, you know, it's a whole fallacy what they're trying to do. Yeah, Mike.
Did you say that an upthrust could be either an up bar or down bar as you define it?
Yes, an upthrust can be either an up bar or a
It
down
just
bar.
had to be high or high.
You're a
Can
high-
you go back to the prior chart? Is the bar following the buying climax, is that an upthrust?
That is. Yep. The question was, is this an upthrust? Absolutely is. See, now in that scenario, I'm glad you guys are picking this up, because you've got a buying climax followed directly after with an upthrust, followed directly after with a no demand. Now, if you start seeing that and you're trading American Express, you're getting pretty giddy. You say, I like that short. Right? You've got 3 bars, one after the other, showing weakness on every bar, as it should. Those are the easy trades. Those are the ones that just picture perfect, and you see it, and there's no questioning them in your mind. A lot of them you're going to question as you try to wrestle with this methodology. You're going to say, well, but it could be this. And a lot of people have trouble with tests. They say, but that test looks, well, that could be a no demand bar. But you got to understand where you're at with the macro view. Right? We don't want to, as I started out this morning, we don't want to sit there and say, well, this bar is doing this, and this bar is doing that. You can't do that. You got to look at the macro view. Now, when we see a no demand bar, I'm not saying you don't look at it. I'm saying you look back and say, okay, if I see no demand, do I see weakness to accompany the no demand? We have a question here?
That upthrust bar also had a gap up at the beginning, at the open.
Yep,
Is that significant at all?
it is. Yeah, the question was that next bar after this buying climax, it gapped up, and from that gap up, it came down to close near its low. That would be a different, see, that would be dark cloud cover in candle terms. In Wyckoff terms, it's an upthrust. But in psychological terms, let's deal with it that way. What does that signify? Look at the previous bar. Where did it close? What do you think the public's thinking about American Express as they see that tonight, not knowing that upthrust is coming? Oh, my God, I'm ready to buy. And that's why this thing gaps up. Specialists know this, right? I mean, this stock is worked by a specialist, and a specialist knows what inventory they have on hand, and they mark the price up to get a following again, because now it gapped up, and now I'm going to get more interest from the public because it gapped up, and in comes the buying, and the professional selling. That all works, it all fits, just like this, once you understand the machinations of how professionals work. Okay, we looked at that. Upthrust, we talked about that already. Volume can be either high or low, right? It doesn't have to be one or the other. It can be an up bar or a down bar, as we said previously, which is good, because Mike's on top of it. That was in my presentation. Can occur on news, and it usually occurs on news, right? Producing higher volume and supply swamps demand at the higher price levels. So I'm going to read that again. We're going to go back and look at that other chart we just looked at. Can occur on news, usually producing higher volume and supply swamps demand at the higher price levels. It'd be interesting to go back, I didn't do this, to go back to, I can't tell exactly what the date, it looks like maybe May 3rd, and maybe around May 3rd to see what the news stories were before the day that happened that it gapped up like that, to see what it elicited from the crowd, right? So that stuff is exactly what feeds professionals' pocketbooks. That's how they do it. Okay, here's a pretty simple one. That's easy to see, right? Now, we're going to look at this in a different way when we do candle volume analysis, but what is that for the candle volume aficionados out there? Shooting star, absolutely. Shooting star. And that's a shooting star in candle volume analysis terms, or actually just in candle terms. In Wyckoff terms, that's an upthrust. And you can see, now it's not really clear, and I don't think it really has gone through, at this point, the distribution phase. We can see a little bit of selling right here, right? And then we see this, and there's your upthrust right there. But that's hard to see as a distribution phase. But as we go through the example I'm going to give you, we're going to talk about that trade setup right there, actually. That's going to be my last presentation. I'm going to dissect that thing and show you what's going on, because there's a lot going on in the background that even if you knew Wyckoff, you didn't see. If you knew support resistance, you knew there was a major, major roadblock right there. And we'll look at that this afternoon. But there's another upthrust. That's the NASDAQ. That's on a 5-minute chart. And this one's a little easier to see. You can see the buying climax, or what it looks to be the initial part of distribution going on. But remember, 5-minute chart, folks. I mean, we talk distribution. We're not talking, my God, the market's going to fall out of bed. We're talking a 5-minute bar, right? So that 5-minute bar has seen some weakness come in because we see the increase in velocity of price and volume. And it's right here. And then if you follow this through, there's a no demand bar, right? There's not a whole lot of people going in. Come up here, there's another one. I mean, so these charts are littered with this stuff once you can see it. Mary?
On the previous chart, you had a very high demand bar on at 9 o'clock.
Right here.
Yes,
Mhm.
and then would you explain what occurred there again? It tested that previous pivot, but it held the high, so that was saying prices were higher.
Mm-hmm. That's a shakeout. That's a shakeout, is what that is. That's exactly what they did. Is it's almost, remember that one shakeout that looked kind of funny? That's almost the same thing. Is the market opened right here. Here's the opening. And it moved up, and then they tried to shake people out, a 2-bar shakeout, followed by that, it's like that 2+ shakeout I showed earlier today. Then it took that last shakeout to move it up. But in moving it up, it wasn't really clear there that you had a lot on this 15-minute chart. It wasn't really clear there that you had like a buying climax going on before that up thrust comes in. You had a little bit of an idea, because you can see here a definite increase in volume, definite increase in the velocity of the price, but and the market reacted to it, which is good too. But it's not like I've been talking about with the dramatic ones that you see in your chart, that it's just that volume bar is that big and that price bar is that big. These are the little things that, as you gain experience with this, you need to understand the little nuances to massage this thing, because they're not going to show it to you like this every day. I mean, those are the easy ones. They're good to show for learning examples. When you get in a live market, it's a lot harder.
And those volume spike bars were reducing in size. The 3 blue bars are reducing. If you drew a line, there's a line going down.
From
yeah,
there.
on volume bars, yeah.
Yeah.
Those, no, to the left.
Oh yeah.
Yeah, those 3, and there's a line right in those volume bars. The line would be going down.
Yeah, I wouldn't read too much. Well, the way you can read into this, which is good, because this is classic volume analysis. I'm glad you brought that up. Classic volume analysis will say, look, the price is going up, the volume's going down. That's not good. You got a divergence between price and volume. The guys that write books about volume, not Wyckoff volume, but just volume, would say that's not good. The price is going to fall, and that's correct.
And at 1110, and then at 1300, those bars are lower.
1110 and 1300. Let's see. Yeah, but I wouldn't read too much into that, because what you really like to see is, after you've seen that, I'm looking more for the other signs of weakness now, up thrust and no demands. Those are going to be the big ones I'm looking for. It's possible that you're going to get a buying climax, but on a 15-minute chart, you might not. You might have to get a bigger chart or a smaller chart. That's the fractal part of it. Okay, so there's another up thrust, and we talked about that one already. But look, what happens 2 bars after that, which Mary talked about, I think, on the other chart. 2 bars after that, no demand. Yeah. So you see how it starts to make sense now. This market and this chart is talking to us if we can learn its language. This language is not taught on Main Street. Nobody talks like this on Main Street. People on CNBC and FNN and all these other news channels, I'm not going to say they don't know this, but they're certainly not telling anybody this. And they're certainly just looking for ways to report, well, the market went up today, or the market went down on profit taking. I mean, come on. They're just trying to make something sound good. Do they really know? We could say the market went up on no demand because no professionals are interested in higher prices, but you're not going to hear that on the news. You're never going to hear that on the news, but that's reality. That's really what happened. And we had a buying climax in the background, and then after that buying climax, we had a lack of demand from professional money. They're not going to report that stuff. That I'm sure they don't know. So I don't think it's, they got this thing against us. They're just trying to hoodwink us, the media. But certainly professional interests are. Okay, we're going to do an analysis summary here, a Wyckoff volume analysis summary. We're going to have some lunch, and then make sure if you need to speak with Ryan that you speak with Ryan. He's going to come up after lunch, and then he's going to leave. He's got an early flight out. So if you want to talk to Ryan Banksy at Infinity, make sure you make some time during lunch to talk to him. But Wyckoff volume analysis summary. Understand how the smart money has to trade. We talked about it, and I know I can talk about it for another hour. I can talk about it the rest of the day. But I also know that 80% of you that leave here, by this time next week, you're onto something new. I mean, I know that, right? You're going to do what you're going to do. I can't force you to do anything. But these methods I'm teaching you today, this is how all markets work. And if you choose to go down the other path, I wish you luck, but I don't think you're going to have a lot of luck. I don't mean to say that arrogantly, but I've been down the other path, and I know that most of those other paths are dead-end roads. You need to understand how to read a chart. And we're reading what smart money is doing on these charts. That's what we're reading. We got to reason out what they're trying to accomplish. That's where the logic comes in. If you were them, what would you be doing in their shoes? That's the only way you're going to really truly grasp this, is to say, okay, This looks like distribution to me on this chart. If I were them, what do I have to do to get rid of my inventory? It's the only way you're going to figure it out. If you sit there and start saying, well, the stochastic did that. I got a divergence there in the MACD. You're going down the wrong road again, right? The right road is to figure out how they're thinking, find their footprints on that chart, and then you can trade with their wind at your back. Strength appears on down bars. I think we beat that to death. Weakness appears on up bars. The reason that that is a truism is because the smart money has to trade like that, right? When they want to buy, they have to buy into the public selling. Otherwise, what's going to happen to the price? If they want to buy when the price is going up, what's going to happen? With all their volume they're going to buy with. It's going to shoot up. They're going to have no profit potential at all. They're going to be now the weak holder. They bought at the top because they created the top. They have to buy when the public is selling. They have to do that 300 years ago, 200 years ago, 100 years ago today, 100 years from now, 200 years from now, 300 years from now. They have to trade like this. Unless they find a different way to trade, which I try to logic it out, and I can't see how they could do it. I don't know how they could do it. And the same thing in reverse for weakness. Right? When they need to sell, they can't wait and say, okay, the market looks like it's topping out to me. I'm going to sell my massive holdings now. They can't. They have to sell into the public buying. They need to transfer that ownership. All that appears on those charts. Trading with the smart money is very profitable. Trading against the smart money, good luck. You're going to need it. Okay, just to wrap this session right here up, what you need to do now, if this has piqued your interest, if you've seen something that makes logical sense to you, for those of you hearing this for the first time, you need to watch this tape over, right? And you really got to get into the nuances. You got to understand some of the ways that we looked at the chart. For those of you that are more, I don't know if mechanical is the right word. How would you describe the way you look at it? Not mechanical, but systematic? Yeah, maybe systematic is a good word. You know, you might want to start applying things that make sense in your mind. Do I need 2.5 times volume? 3 times volume? Those are things to play with as an individual, right? I don't have the answer for that because I just see it. I'm more of an artist when it comes to the chart as compared to a systematic trader. I've had my fill of system traders. They don't work for the most part. I haven't found them to work anyway. But study these price volume patterns. These patterns show up slightly different with different subtleties, right? And this is what makes it a little harder. Because that MACD, when it crosses, it crosses. If it crosses like this, or if a moving average crosses, it crosses, right? There's no subtlety to that cross. When you have a divergence in a MACD or stochastic, there's no subtlety to it, it's there. But when you look at reading these very crafty people that are trying to take our money from us, they make it look different almost every time. And they have to, because if we just get trained to look for this certain pattern, oh, I saw this last week and I made $3,000. Well, guess what? You're not going to see it this week. Most likely, you're not going to see it next week. They're not going to try to repeat that pattern. Patterns do repeat, but never the same way verbatim. Not with enough frequency for you to make money doing it, in my humble opinion. These patterns are fractal in nature. They work in all time frames and in all markets. So it doesn't matter if you're trading corn or crude oil, or you're trading the S&P minis, or you're trading stocks. If you're trading options, you want to look at the underlying, right? Make the decision on what the underlying direction is going to be, and then make your option play. We know in options that most option buyers lose money. Most options expire worthless. So if you've got a deep enough bank account, you can sell options. You can sell credit spreads. If you want to take advantage of option premium and get that instead of trying to buy options and time that, because options are a whole different animal. You've got time decay. You've got all kinds of different, theta, beta, delta, all these different things that make it more complicated. But this is still usable for the options traders, right? We're going to look at the underlying, make the decision on the underlying, and then make the options play that makes sense with what we look at with the underlying that we're looking at. Okay, there's more to study and learn, obviously. There's more to Wyckoff. One place I would tell you to go, and I don't know, I don't think they're in business right now. I mean, they're in business a certain way. If you go to stockmarketinstitute.com, he's got some kind of service. Craig Schroeder runs it, but I don't, they used to sell the Wyckoff course. It's a good course. I recommend it. It's a good place to go and get a course that's reasonably priced, or at least it used to be. It was under $1,000. There's a lot of study to it. There's a lot of terminology, but it gives you more background here. I'm an expert in this. I've got a new website. That is traderscode.com. I have a chart of the week that I'm going to start, a video chart of the week free service that I'll start applying these principles on charts every week, so you can have this come to your home and you can look at it at your leisure. My website, the teaser page is up now. The full website will be live in July, and I'll be doing a lot of this stuff. Obviously, I'm an educator. I educate with this stuff, so if you want to look for help there, you'll find more stuff on my website as time evolves.